and welcome to ICT Simplified. Today you're going to learn about the ICT order block. I'll teach you what creates them, how to identify them, and finally how to use them. So the first thing we'll cover is what creates them. So let's use our bullish and bearish diagrams for example. What you want to look for and what creates an order block is a draw on liquidity. In a bullish example, it would be the sweep of a low, and in a bearish example, it would be the sweep of a high. The next thing you want to look for and what makes an order block valid is a break of structure. In a bullish example, it would be the high of the price leg which did the draw on the sell side liquidity, which is right here. In a bearish example, it would be the low of the price leg which did the draw on the buy side liquidity, which is right here. So now that price has taken liquidity and broken structure, where's the order block? In a bullish example, it's the single or series of down close candles which did the draw on sell side liquidity. So usually around here. In a bearish example, it's the single or series of up close candles which did the draw on the buy side liquidity. The order block usually resides in this area here as well. Now that we've covered what creates and how to identify an ICT order block, let's go over some entry techniques. Depending on how the order block forms, I'll use different entry techniques. My favorite type of order block is large candle bodies with small wicks, such as these ones. At this type of order block, I enter at the opening price of the order block. If the order block has a long series of down close or up close candles, I enter at the mean threshold of the order block. The mean threshold of the order block is simply the 50% fib retracement level from the lowest to the highest point of the order block. If the order block forms with a large wick, such as these ones, I enter at the closing price of the candle or at the beginning of the wick, which is right here. Usually these order blocks are considered low probability, but if I'm going to enter, it would simply be at the closing price of the last candle which created the wick. For our first example, we look into a bullish example on the Euro USD 5-minute time frame. As visible, we got sell side liquidity resting below this price point. What we want to see is a sweep of this low and a close back up above the sell side liquidity price point, followed by a break of structure, ideally here. So let's see what happens. As you can see, price closed above the sell side liquidity price point. What we want to see now is a break of structure up, which would be at this price point. Let's see what happens. As you can see, we broke structure and now we can enter a trade once price reaches back for the order block. For this example, we'll enter at the opening price of the order block. Now let's see what happens. As you can see, the price reacted at the order block and continued upwards. For our second example, we look into a bullish example on the Euro USD 15-minute time frame. As visible, we've got sell side liquidity resting below this low. What we want to see is the sweep of this low, followed by a break of structure and a return to the order block. So first, let's see if we can sweep this liquidity resting here. Okay, so now we have swept the liquidity resting below this low, and we have also gotten a close back up above the sell side liquidity price point. And what we need to see now is a break of structure, which would be right here. Let's see what happens. So now that we have broken structure up, we now have a valid order block right here. The order block are those two candles. For this trade, I will enter at the mean threshold of the order block, since it's a pretty large one. So let's see if we can get there. Now let's see what happens. So as you can see, we reacted off the mean threshold of the order block and continued upwards. So it's very simple. The first step is to identify the liquidity. Second, see if price sweeps the liquidity and closes back above the sell side liquidity price point. The next thing you want to look for is a break of structure and a return to the order block. Depending on how the order block looks, you enter at either the opening price, the bottom wick if it's really large, or the mean threshold if you've got a larger order block like I have right here. For our third example, we'll look into a bullish example on the EUR/USD 1 hour time frame. As visible, we've got sell side liquidity resting below this price point and this price point as well, because this price leg didn't sweep this liquidity. So now we have got two equal lows. So let's see if price sweeps this liquidity. So as you can see, price went below, closed back above the sell side liquidity price point. We have also gotten a break of structure right here. And since we have gotten a break of structure, we have now got a valid order block right here, consistent of these three down close candles. So now that we reach back for the order block, we can enter a trade. And for this example, I will enter at the closing price of the last candle, which is also at the top of the bottom wick. So I'm going to keep my stop loss at the bottom of the order block and my take profit point at the fair value gap resting above. So let's see what happens. As you can see, we got tagged in right there and went upwards towards the fair value gap. So as you can see, all a order block really is a sweep of sell side or buy side liquidity, followed by a break of structure and a return to the order block. And the order block is always and will always be the single or the series of down close candles which swept the liquidity prior to the break of structure. Same thing goes for the bullish example. You want to see a sweep of buy side liquidity, which we have right here, followed by a break of structure, which we have right here, followed by a return to the order block. In this case, it's a very large order block, so I would use the mean threshold, which is right here. In this case, I think the trade will fail just because we're in a uptrend or a bullish order flow, but we'll try it either way. As you can see, this trade failed because we are in a bullish order flow or a uptrend, but order blocks will always be the sweep of liquidity followed by a break of structure and a return to the order block before continuing upwards or downwards. In the future, I will cover all of the different ICT blocks, such as propulsion blocks, breaker blocks, and mitigation blocks. I hope you found my first video simplifying the concepts helpful. If you got any questions regarding the order blocks, please leave them in the comments and I will answer them as soon as I can. See you in the next video where I will be covering the mitigation block.